All right, everybody, welcome back to another episode of the Erickson Brothers Podcast, where we discuss questions that we really don't know the answers to and talk about the possible returns on life's investments. So today, in conversation before Jeff and I started recording, we were just talking about giving our money and tithing and what we feel might not always be what God has called us to, and giving out of abundance and not scarcity and that kind of thing. So we're going to get into that. I'll go ahead and share my recent developments around that. So I decided to set up a giving account in just a straight giving account that automatically puts 10% of each paycheck um into just a general checking account. And what I found was that I set this up and I just wanted to make it very easy for me to be able to give and tithe, just like so I have this money that I know is not my own and I know will be given in one way, shape, or form. And I set that up probably 6 to 7. No, I guess not longer than that. It was probably a month and a half, 2 months, maybe even 2.5 months, because I think I've had like 6 or 7 paychecks on it. So that probably means 3 months. Yeah, 3.5 months. Anyway, so this money was coming into my account directly from my savings account every month. But I hadn't planned what I was going to do with it yet. So I had this uh, big bank, or not this big bank, but I was putting money into it every week, but I actually hadn't given it to anything yet. And I was thinking to myself, like, this is getting to be like a good amount of money. Like, I could easily just like throw this into the checking account, like pay it, like just and like throw it back into the savings account. Like I could use this money. And then I was like, what, like that just defeats the whole purpose of why I created this account. So after we'll go with 3 months of a not having any money flowing out of the account, I finally just set up reoccurring giving to my church. That'll happen every 2 weeks. And I think the I'm right now 10% of my paycheck is going into this giving account, and then I decided to put a little bit less than that into the church that I go to every week, because there's some other things that I'd like to give to, including like athletes in action at Yale, and I think like end of the year giving, or just like one time things that are important to me, that I'll have that money there for, that I know it's not my own, it's God's, and whatever's on my heart, I have this fund for. So it I think I'm doing, I'm making it as easy as possible. I have the account, I have money coming into it and out of it automatically. But for some reason, like the past like 2 weeks, I was like, oh, I could easily just throw this back in my spending account, back into my savings account. I wouldn't think twice. And I was like, well, since I hadn't given 10%, so like maybe I'll just start it now. I was like, no, no, like this is not what we're doing. I put my foot down and decided that. But it is I didn't think it would be a challenge even once I set up this account. But even still, there's just like the pull, like the selfish pull to be like, oh, I need this money more than what I could be giving it to. But that was my little update. I'm happy with how I have it now, both automatically coming in and automatically going out. And then I'll continue to track it and uh, be able to give in times when it's not going to be an automated thing, like more of a one-time gift. So I'm excited for that. and I've made it as easy as possible for myself.
Yeah, dude, that's awesome. And that's something that uh, my pastor was mentioning earlier. And the first thing I thought of is like when we decide where we spend our money, we are saying we are better owners of our money than God is.
Hmm.
And we know we have a better idea of what to do with the money and with our resources and with our gifts and our talents than God does.
Hmm.
And it's like looking at it through that perspective, it's like, holy cow, like you really have to put it in proper context, knowing that like God is the one who all good things come from, and God is the one who abundance flows through. And he uses us to be able to grow his kingdom. So we kind of have to allow ourselves to be coachable in a way. Um,
Hmm. Hmm.
yeah, no, that's awesome. I think that's a great thing that you set up. Something that's
Yeah.
tough. Something that's tough for me is my income is not steady, and it is not something that's predictable either. And it's extremely hard to trust God and to have faith in God that He's going to be able to bring clients into my life and be able to bring prospects and business partners into my life because it's all dependent on Him. It's all in His hands. And I know God blesses people that work hard. God blesses people that are getting after it and are putting their head down and um, yeah, just working hard at the end of the day. But I also have to know that there's the faith and the trust component of it is crucial. So
Hmm. Yep. Good point. I think that that's what it comes down to is trusting him and knowing I I hadn't had that thought in a while that God is going to be doing something better with our money than anybody else.
mhm.
Like that, I think I'd heard that before, but it wasn't like a reoccurring thought. And uh, it's it's a good reminder for me, like going forward. It's like, hey, like now that I have the automation set up, like whatever's on my heart, I can just give to, and don't need to give. I don't need to like think about it because I have this account,
Mm.
and it's just like, hey, I hear about like like a missionary or a volunteering opportunity or whatever it is, I can just be like, sure, like
Mhm.
I think I can just listen to God in that context and see where he points me. So yeah. Um, moving on from that, uh, Jeff, did you have anything that came up this week? How did you invest your time? How did you invest your money? Where have your thoughts been?
Yeah, kind of going back over to the theme of our podcast in terms of um, yeah, just investing in things we don't necessarily know the returns to, and just being able to talk about that at a young age. Um, yeah, honestly, it's more the same, but that's a good thing. And I'm in a really good place right now. I know what I need to be doing in order to be successful. I'm
Mhm.
doing it, and I'm getting good results. I just have to be doing it longer. And a quote that's just been sitting in my head like an itch that I can't stop thinking of is success comes to those who do the boring and repetitive work the longest.
Mhm.
I'm going to say that again. Success comes to those who do the boring and repetitive work the longest. And like I'm at a place where it's like I've been doing this for 6 months. I know every day is um, a lot of the same things in terms of prospecting, looking for new clients, looking to expand your business, right? A lot of same things, and it's boring and it's repetitive, and I just know that I have to keep on turning the wheel and keep on running it through the system. Um,
Mhm.
Longer than anyone else is willing to wait. And what's nice is I have time on my side. I'm only 22 years old. I have another
Mhm.
80 years to grow this thing big. So I have a lot of confidence in that. It's just how I'm investing my time and my money is I'm investing my time in boring work. And it's not fun and it's not sexy. And I'm not
Mhm.
making hundreds of thousands of dollars a year yet. But kind of like having faith with investing or having faith with tithing, like what we mentioned earlier, I'm having faith in knowing that um, there is a compounding process to efforts and there's a compounding process to relationships and to business and to um, habits as well. So that's what I'm doing. And yeah, a lot more of the same, but it's kind of like a perspective that I had that I wanted to share. What about you?
Mhm. Yeah, more of the same for me on my end as well. Got that test coming up now 2 weeks from yesterday. So
Cool.
last week spent a lot of time studying for that, and this upcoming week will continue to study for that. So a lot of my time is going into that outside of work, even though it is work related, but even outside of work, like a lot of things that I usually do, including like working out, going to dinner with friends, or just hanging out. That those things will, uh, starting yesterday, those things are going by the wayside for the next 2 weeks, so I can hit this hard. And it shakes up the routine a little bit, even at work. Just prioritizing this test over reading articles on market updates or reading Bloomberg or trying to learn from the people above me. So that's how I'm investing my time, money. I think that we talked about the giving aspect, and so I'm happy that I finally just made it an automated system, and uh, investing my money, like my bonus for next year comes in. It's only from 2 months of work, so it's not a lot by any means, but that'll give me some more, um, that will give me the cushion I need in order to feel comfortable to start investing independently through a brokerage account. So I think I was looking at like New York City municipal bonds out of it, just randomly got like a email from that, but like they return well, and the market right now is so shaky with stocks. And I think since I already put a lot of my money into stocks every 2 weeks, I think that it'd be interesting to like get into like bonds and even trading those on my own. So that's where my thinking is at. Um, priority, uh, priority number one though is this test. So yeah. Mhm.
Yeah.
Mhm. And yeah.
I was gonna say, and one perspective on investing that I've learned recently is when you're early in your life, your money should be going towards increasing your earning capacity, right? Because if you look at what's the return of, say, $10,000 you're putting into dollar cost averaging the S&P 500, I don't know, that may double in like 5 years if you have great returns, right? But
Mhm.
like how much easier would it be to double your income in 5 years
Mhm.
if you invest in developing skills and invest in character traits and even
Mhm.
beliefs, like reading books. Like reading books can give you the
Mhm.
proper money mindset. It comes to
Yeah.
uh, growing your income. And that's something I didn't know earlier. Like literally, if you had asked me like 6 months ago, I wouldn't I wouldn't have had that thought process. But at least for me, it's important that I know it's like no investment I'm gonna make in my 20s in terms of buying a stock or a bond or an equity or putting money in life insurance, whatever it is going to be the thing that is going to hit. It's actually investing in the S&Me 500 that is going to have the biggest returns. So
Mhm. Yeah.
I love that. But yeah, I mean,
Yep.
at the same time,
Yeah. I guess that reminds me of some of the things that I've set up the S&Me 500. Like I've got a few networking calls with people in the industry that I'm in, and I think I'm a lot of times people use these and leverage these for a potential job, but for now I'm starting to talk to people just to make sure that I'm thinking about the right things. I'm learning. I am just it, soaking in as much information as possible. So uh, I've got um, I've got a call on Wednesday, and I think I can afford a half hour or an hour to speak to this guy, especially since he's going to be teaching me a lot of things, and I'll be learning from him. So that's another thing that I'm looking forward to doing is being more intentional uh, with my time outside of work, especially now, or especially when I finish these tests. So looking forward to that.
Love it.
Hmm. Hmm.
Love it. Cool. So two topics down. Last topic. What do you got for us? Number 3 for the day.
Number three, I've mentioned we've been talking about the markets a little bit, but I think it's really interesting what's going on with how the market responds to uh, inflation data and unemployment data, and especially like both of those, what the Fed speaker Jerome Powell says. So, and I think it's like kind of it makes sense. What happens, but it is backwards. So right now, whenever there will be like a like most recently like the January inflation data came out, and then a few weeks after that the January jobs report came out, and inflation was a little bit higher, so not good, and unemployment was and still might be the lowest that it has been in over 53 years, and which it sounds like a great thing. But the market, um, the days following those announcements, acted in ways that I wouldn't expect. Or maybe I should expect it, but anyway, inflation data hotter than usual. That means that the Fed will start, or the Fed could indicate that they will slow their rate hike, and then maybe even begin to lower it at the end of 2023, which sounds like a good thing. Like, great. But and the market saw that as poor. The market saw the inflation data as poor because that means uh, that that the Fed will continue to have to raise rates. So it was kind of backwards. And then most recently, uh, unemployment data was low, and meaning that the jobs market was really hot, and then the market had a really bad day because that indicated the employment data indicated that the Fed will continue to raise rates and keep them higher for longer. So it's a good metric led to a negative outcome, and I think it makes sense logically in this realm of raising interest rates and preparing for a recession. But it is interesting to me how good data numbers or bad data numbers lead to bad days in the market, or consequently good days in the market. So,
Yeah.
mhm.
No, I like that. And I mean that's important to know, especially at your position and what you're doing. So that's good to know. I didn't know those updates at all.
Yeah, it's been interesting, but because you would think, oh, unemployment's lowest it's ever been, market takes off, right? That's what you would think.
Mhm.
Like the market in my mind should hear, oh, lots of people are working, they have jobs, that means lots of output, lots of future output, market should do well. But it's more, oh, lots of people have jobs, the Fed will continue to suppress that and make less people have jobs, and they're going to continue to make it harder for people in the in the near term and long term. The market affects uh, reacts poorly to that. So, um,
Well, it's
yeah,
almost like as you cut away jobs, it's like it's getting healthier, right? Like the economy itself is getting healthier. Is that a fair statement, or what would you say to that?
no, I think well, the main thing is the main thing for the Fed right now is inflation. So they look at inflation data and then decide to raise rates. So at the beginning of January, people were thinking, oh, like the Fed funds end target rate at the end of 2023 might be like low fives range. And then since inflation continues to stay high, people are now thinking that the peak Fed funds target rate will be like high fives range. And then I've even talked to people that think it'll be like low sixes. So like that's their main priority. But right in Fed in within the past like 40 or 50 years, they have taken this thing called the dual mandate into their thinking, where they look at inflation and unemployment, and those things kind of work in opposite with each other, because the more people that have jobs will lead to more output, which will overall be a higher price level, um, and which will lead to more inflation. And if you have less jobs, then there's less output, less price inflation. But then you also have people who are out of work and less jobs, and like the obvious implications of that. So there historically there's been this dual mandate between unemployment and inflation, and uh, what might happen going forward is they probably won't bring rates down until people start getting laid off, which because that will be like an indicator that like what they're trying to do and raise rates and like dampen the economy is actually working. So it's like a
Gotcha.
constant game on their end, and then what the market does is like a constant reaction to what they're saying. And up until this point, the market has been pretty resilient to the Fed, um, to the Fed, and they're speaking like it was a horrible year in 2022 for like the traditional portfolio of like 60 stocks, 40 bonds. Like it was the worst year ever for that allocation. Um, but there continues to be strong like indicators in the market that over time the Fed will have to raise rates late into 2023 and then keep them high for who knows how long. People think like Q2 2024, maybe longer. So it's a constant game, but I like it. Um, I hope that makes sense to you, Jeff.
It does.
I'll
No,
describe it. Okay.
yeah, no, it definitely makes sense, and I'm following along. Um, that is interesting how you know when to stop raising rates because people just start getting laid off.
I
Uh,
mean, there's a lot of things, but like that's one of the things that they look. That's like one of the big things that they look at, or at least historically it has been. Uh,
well, see, I would have thought they would have already seen that because what we've noticed in the tech industry, uh, and the softwares across the board, like there's major layoffs from some of the biggest companies, like Amazon laid off a bunch of coders, Twitter dropped half its employees, like
mhm, mhm,
Google dropped a bunch of employees. Like there's huge tech companies with massive layoffs, and uh,
mhm.
one, I was surprised to hear that unemployment is at the lowest it's ever been, and
In 52 years, 52 years.
52 years. But still, like what I hear about on my end, and in my line of work is there's these huge layoffs and there's a lot of people looking for work, so that our opportunity is going to be able to appeal to a lot more people
Mhm,
because a lot of companies are laying people off, right? So people are going to be looking for part-time income or full-time income, and possibly
mhm,
transitioning into the financial space, which traditionally is recession proof. So, yeah, I mean, that's what I've heard, but obviously,
Mhm.
like the numbers from the Fed are going to be a lot more.
Yeah, yeah. It is interesting that these big tech companies have laid people off, and but people don't seem to be concerned because they're laying off coders and software engineers, and they're not laying off factory workers, truck drivers,
Hmm.
uh, uh, manufacturers, like I
The
guess
blue
more blue collar in a sense. So it people don't seem to be concerned with laying off the computer science major, which is interesting to me. But I think I've had two thoughts around that. One is that these big tech companies just have a better understanding of what the future will be, so they're preparing for a recession and they're laying off people and getting rid of excess waste because they know the end of 2023 will be tough, 2024 will be tough. They don't need 15 coders doing the work of three.
Mhm.
So I one thought, yeah, that's the first thought. They might have like a better grip on what's going forward because they are in so many spaces. Like for example, Amazon is in they're the one of the most diversified companies in the world, and like my thought is that they have their own CPI index measuring inflation of like the cost of goods going getting sold on their website, and the supply and demand for things like Amazon Prime and uh, Whole Foods. And I think that they're in just so many sectors that they have a really good internal view of what the future is. Um, and they don't want to waste time, and they're trying to like thin the fat. So that's my first thought. My second thought around these big tech companies laying people off and it not really affecting uh, the rest of the job market is that there's just so many people out there and so many jobs, and 5,000 people getting laid off from Twitter or 10,000, whatever it was. Like that's just like a drop in the bucket of really how many workers are out there. And if that's probably like less than a percentage, or I don't know how many people work at Twitter or Amazon, so I don't want to give a percentage, but that might get a lot of news, but is it materially indicative of what's to come? I don't know. So the competing thoughts on my end that don't really line up, but like that's I go back and forth between the market's so big that one company that lays off a few thousand workers, like no big deal. Like it just gets a lot of press because of Elon Musk and Twitter and Amazon and Tesla and all these companies. Like they're just going to get the press, or is it indicative of, oh, these companies actually have a good grasp on the future and they need to start like finding money where they can, and it starts with like the X number of coder. So yeah.
Yeah, cool. Cool. And when you initially brought up this conversation and you started talking about interest rates and inflation, I was just like, man, is it like such a great time to be a business owner and to be an entrepreneur? Because how I've learned it recently is as interest rates go up, right? It's great to be a business owner because you can control the prices, right? So things get more expensive to buy, you can control the prices to your end consumer, which allows you to kind of mitigate inflation for yourself. So
Okay.
I've always thought that was fascinating. Like, say you're owner of an apartment complex, your debt gets more expensive, so you refinance at a higher rate or whatever. Again, which probably be stupid, but go along with the metaphor or go along with the example here. Your debt
I
gets
mean,
more
but like
expensive.
that's what's happening is that people that need financing, companies, apartment owners, like they are refinancing because their debt is coming to maturity, and they're realizing that this time might be as good of any to refinance because they know in when they have to refinance in 2023 2023 or 2024, it's going to be even more expensive. Like interest rates are
Right.
going to be higher. So some people are coming to market and saying like, you know what, like even on a personal level, like, oh, like the same mortgage, the same like $1 million mortgage is going to cost me twice as much on monthly payments because of interest. But if you look a year from now, year and a half from now, like who knows like how expensive it could be. So I think some companies are saying like, hey, we need to do this while we can.
Mhm.
But continue with your thought.
Yeah. Anyway, so imagine you're an apartment complex owner. You have to
Hmm.
refinance your debt, and it's going to cost you more. But one
Hmm.
way to kind of offset that cost you take on as an individual, being a business owner, and then as a company, being the business itself,
Hmm.
is you would raise the cost of the apartment complexes. So you raise rents,
Hmm.
right? So why it's important to be a business owner and why it's important to be an entrepreneur or to be someone that kind of controls the money flow is
Hmm.
because when things get more expensive, you're able to artificially offset that yourself. Whereas if you're just a W 2 employee and you have one stream of income and you're 100% reliant on your employer and 100% reliant on the cost of a dozen eggs at the grocery store, then you don't really have much say in how much money you make or how much money you can spend.
Hmm.
Right?
Hmm.
You're a cog in the wheel, and
Hmm.
that sounds like my nightmare, and um, that sounds terrible. That sounds like hell. And
Hmm.
I want to do the best I can to not be dependent on somebody to tell me where I can live or where I can send my kids to school or what food I have to eat or what I can provide to my family on the dinner table, like whatever it is. Um,
Hmm.
it's like you mentioned interest rates. I think being a business owner is good because you can offset interest rates. So um,
Hmm.
that's just kind of how my mindset works around this,
Hmm.
and I wanted to share
Hmm.
that because
Yeah. Yeah. But also, like, it's good to be a business owner, but like the downstream effects of raising interest rates, like the ultimate goal is to slow down the economy. So when the Fed raises rates and you can just say, oh, I'll just increase my rents, you can do that, but then your tenants, like some of them won't be able to afford it anymore, right? Or they're going to be squeezed, and like that will slow the economy down. Or like if you have a property manager and you're like, yeah, I don't need two property managers, I just need one, and I'll do the work and fill in the gaps. So it's not like effects are completely mitigated if you are a business owner, but you still need to like weather that storm. But it is um I guess like I'll continue the thought with like rents. Like if you raise rents and people move out and people don't move in, like that's a problem too. And you're like, oh, like I have to charge uh like X plus 200 now, but nobody can afford X plus 200. So now instead of getting X, I get nothing. So but like you do have control, but it's not autonomy because you're still dependent on people to get things done, people to pay you rent, people to uh like handle the day to day if you are a business owner. So um
yeah.
lots of lots of things to consider, but you are definitely in control or more in control.
Mhm.
Hmm.
Cool, cool. There you have it. Um, we knocked down all three. Um, Gave our updates on time and money investment, and yeah, that just about wraps it up for this week. Um, yeah, Matt, any closing thoughts before we finish up episode 7 here of the EBP?
Episode 7, like that's not one. We're we're sticking to it. So it's I'm glad we've committed 7 weeks now. I knew we would, but it's good to have that backfill of like, okay, this is the routine that we do. This is we said we were gonna do it and here we are doing it. So I feel like episode 7 we're like kind of in the middle of it. and we'll be in the middle of it for here on out. So
Mhm.
I'm excited. Yeah. I just want to, my mantra that I'll always say at the end is just how you do anything is how you do everything. So that's, it'll be a good week. So
It'll be a great week, and I'm ready to kick some ass, take some names, and to do some boring work. So great chatting with you, bro. Finishing up episode 7 here, Erickson Brothers Podcast. Matt and Jeff Erickson. We're out.